All right, in this lesson, we're going to walk you through dividends. Specifically, we're going to walk you through cash dividends. We're going to give you a basic understanding of cash dividends, and then we're also going to walk you through the life cycle of those cash dividends and what they would look like when we make journal entries into the books of the company. So let's get started by helping you understand why people invest in stocks. So why do people invest in stocks? Well, there's really two reasons why people invest in stock. The first reason why they invest in stocks is the earning potential or the gain potential of the stock price. So you buy a stock for $10 a share. Over a year, it grows to $13 a share. And so you've made $3 a share. And so people want to see an increase in their investment. That's what they get for investing their money in this stock. And so one of the prime reasons people invest in stock is the growth potential of their money and their investment. Now, the other reason why people invest in stock is due to dividends. And so dividends provides an income to the person that receives or that owns that stock. And so a lot of people invest not because of the growth potential, although that's important. They're investing it because of the dividend potential, the dividends that they would receive every so often from the company. And remember that dividends are a distribution of a company's earnings. And so really the investor is getting part of their earnings back in the form of a dividend. So this is why people invest in stocks. And our concern here is this one right here, dividend payments. So we are looking for why and how dividends occur, because those people that invest in stock want those dividends, and we're going to have to report them in our books properly. So that's what we're going to be looking at in this lesson specifically. So talking a little bit about dividends. So dividends, now specifically cash, are distributions of a company's earnings to shareholders. Now we'll talk about in some instances that there are non-cash dividends, but specifically we're looking at cash dividends here. Now companies do not and are usually advised against this to distribute all of their earnings to investors. And what we're meaning here is that if a company makes $100, they don't distribute all of that to their shareholders. And there is a good reason why. And that reason is that they need some of that cash to be able to reinvest in the company to make it bigger, increase revenues, increase profits, return better returns to their investors. So they need additional capital in order to do that. And there's really three ways that a company can reinvest in themselves. One of them is to take out debt, but the problem with that is that it incurs interest expense, and so that's not always the best way of doing it. The second way that we can increase investment into our company is we can sell more shares, but as we've seen in this section, by selling more shares, we dilute the shares that we already have, and so that's not always the best thing to do. And then the third option is we can, if we're profitable, we can just retain some of that earnings and use that to reinvest. That is usually the simplest way of doing it, because you're not issuing more shares, which has a cost to it and also reduces the value of all the shares that are outstanding. And we're not taking out debt, which has to be repaid and has a cost in the form of interest expense. And so by reinvesting some of the profits, we're able to reinvest in the company. So you're never really going to see a company that issues more dividends than what they've earned. And that's a good thing. So when we talk about dividends and we talk about investments, there really are two types of investments when it comes to a look at these investments from a dividend perspective. The first type of investment are non-dividend paying companies. These are companies that don't pay a dividend. They are known not to pay a dividend, and there's no expectation in the future they will pay a dividend. These types of companies are called growth investments. The reason why they're called growth investments is they're literally taking all of their earnings and reinvesting in their company. By reinvesting in their company, they're hoping to increase the shareholders' value of their stock or their investment. The other type of companies are dividend paying paying companies. Now, these dividend paying companies are also called income investments. And the reason why is they are investments to the shareholders, but really the shareholders want the income from them, not necessarily the growth potential. They still want growth, but they don't need as much growth as maybe a true growth investment. What they're really caring about is that check that they get from their investment in that company. So income investments are our dividend paying companies that we are looking at in this lesson. Now, there are some rules to think about when it comes to dividends. So in order for dividends to be paid, there must be two things that have to occur. The first one is that the company must have sufficient retained earnings. They have to have earnings to be able to distribute earnings. So if they don't have any earnings, they can't distribute earnings. So you can't distribute if you don't make any money. That doesn't mean that companies haven't done it in the past. A company technically can distribute a cash dividend if they don't have any earnings, but we call that instance is a liquidation of your investment. So not necessarily the greatest reason to pay a dividend. So we're looking for sufficient retained earnings to be able to pay a dividend. The second thing that must occur is that we must have sufficient cash. If we don't have any cash, we can't pay a cash dividend. So obviously that's an obvious one there. We've got to have cash to be able to pay dividends to our shareholders. So there may be reasons why a company doesn't for instance, pay a dividend, and they might be profitable. It might just because they don't have any cash. Why might not they have cash? Maybe their customers haven't paid them for a lot of the goods that they sold. So maybe they are profitable, they just don't have the money to be able to pay because they're still waiting for receivables to be collected. So again, you must have retained earnings and you must have sufficient cash in order to pay a dividend. Now, if we look at the timeline for a dividend, I want you to see the life cycle of how a dividend works. So the first thing that happens is what we call the declaration date. This is the date at which the board of directors approves the dividend. So the board of directors is the one that calculates and approves a dividend that gets distributed to shareholders. Now, on that date, the board of directors will meet, they'll vote on it, and then it's declared on that date. When that happens, a liability occurs on that date. So we're going to have to do a journal entry for the liability on that date. Now, specifically, shareholders do not get the money on that date. It's literally just the board declaring the dividend, and then a liability is booked into the books for the dividends that they're going to have to pay. Now, after that point, we got to figure out who gets the dividend because shares are traded every single day on the stock, well, every working day on the stock market. And because of that, we have to figure out who gets the dividend. So there is another date that is kind of prepared by the board of directors. That's the date of record. And what that date does is that's the cutoff date at which you must be a shareholder of that stock in order to qualify for the dividend. If you are not a shareholder on that date, so maybe you were a shareholder and then you sold it before that date, you wouldn't get the dividend. So that is the date of record. That date of record is not a journal entry date. That literally is just us pulling a listing of everybody who owns a share on that date, and then those are who are we going to pay. If the shareholder decides to sell the share right after the date of record, they will still get the dividend. So they still get the dividend even though they're no longer a shareholder because they were a shareholder on the date of record. Now, after this date of record, there is the date of payment. There is a lag between the date of record and the date of payment. The reason why is we got to figure out first who gets the dividend, and then once we've got that, we got to figure out, okay, how do we pay them? We've got to get the money in their hands, and that does take a little while. So for some companies, it may be a week or 2 weeks from the date of record to the date of payment. So just know that there is a time lag here. And then on the date of payment, we're going to reduce our liabilities and we're going to pay the cash to our shareholders. So there is a journal entry on the date of payment. So the date of declaration, we do have a journal entry. The date of payment, we have a journal entry, but the date of record, we don't have a journal entry. Now, one other thing that we don't have here on the timeline is the closing of the dividends, which we're going to show you at the end of this lesson in the journal entry. So just know that it's not on the timeline, but we would close the books because this is a temporary account. All right, so let's look at an example here and walk you through the life cycle of a dividend payment. So assume on September 30th, Company A's board of directors declare a $1.25 dividend on their 5 million issued and outstanding shares with payment on November 1st. So notice it says issued and outstanding. So we've got 5 million shares that we're going to have to pay a dividend to. The date of record is set for October 15th. Prepare the journal entry for the declaration, the date of record, and the payment. So first off, we know that on this date, the date of declaration, a liability has been established by the board of directors. They're now obligated to pay $1.25 per share that's outstanding and issued. So we're going to have to calculate what that liability is going to be. So we know that there's 5 million shares, and we know that each share is going to get $1.25, which means that we're going to owe $6.25 million to our shareholders. So because we have established a liability here, we're going to need to create a journal entry to establish that liability. So our journal entry for this is we're going to credit dividends payable because we owe it. So increase in liabilities would be a credit. So we're going to credit dividends payable in the amount of $6.250 million. And then we're going to debit our dividends account. So debit dividends for $6.25000. So $6.25 million. So that would be our journal entry on the date that we declare the dividends. All right. So let's move on to the date of record. So on the date of record, we said that we're just getting a listing of who is owed the dividend. As such, there is no entry here because we're not establishing a liability and we're not decreasing our liability. All right, so moving from the date of record to the dividends paid. So now that we know who we're going to pay and we're about to pay, now we need to pay them. So the journal entry for paying them, we know that we're going to reduce our liability because we'll no longer owe it. So we're going to reduce our dividends payable for the $6.25 million. To do that, we're going to debit dividends payable in the amount of $6.25000, and then we're going to credit cash because we're going to pay cash of $6,250,000. So that is what our entry would look like on the day that we paid. So that would complete our problem here, but we're going to take it one step further with the closing of the dividends account. So we need to close the dividend account. Now, to give you a T account here, right now, dividends payable is sitting at 0. So we don't need to close that out. Also, it's a liability, so it wouldn't be closed out. And then right now, we had a dividend account that is sitting at a debit of $625,000 for the dividends that we paid during the year. So now we need to close it. So to close it, we are going to make this dividend account 0. So to make it 0, I need to put a credit of 625. That's going to zero out the dividend account. So credit dividends for 625. And then we're going to close this out to the retained earnings. So we're going to debit retained earnings in the amount of $625,000. Okay, so that's what our entry would be at the end of the year when we closed out our books. Remember, we close out our books after we've done the financial statement. So once we prepare the financial statement, we'll close the books so that they're ready for next year. So next year, dividends accounts would be 0, which would be, that's correct because we don't care about what dividends we paid in the past. All we care is what we pay currently in the current term. So we'll close that out every single year. So that is our closing entry for the end of the year. So that is a lesson on cash dividends. We helped you understand what cash dividends are. And then we also took a look at the life cycle from a journal entries perspective of cash dividends. So hope you enjoyed this lesson, and we'll see you in the next video. Hey guys, if you like this video, make sure you press the like button below. And if you're looking for worksheets that go along with all of these lessons, head over to my website at patrickleemsa.com or click in the link in the far right. And I've got your next lesson right over here. So just click that link and it'll take you to that video. So until then, we'll see you in the next lesson.